My, has it been an insane few days for global financial markets? The S&P 500 saw its biggest rise since 2008 yesterday, and it's one of its biggest intraday swings in modern history. The intraday swing for the S&P 500 was 10.8%. That's the fourth biggest since World War II. It's only behind the best 2 days in the global financial crisis and the day after Black Monday in 1987. And there was a lot of volume behind this. Record total volumes on the U.S. equity exchange yesterday, and one of the biggest one-day surge in the Mag 7. It's no question that chip stocks outperformed, tech stocks outperformed yesterday as well. And then on the credit side, we go over to fixed income. Corporate bond spreads had their biggest rally since 2020. A lot of this anxiety about a U.S. economic slowdown that has widened out credit spreads in the last week or so really unwound yesterday on this announcement. This big jump in risk sentiment really taken the market by surprise. It was quite a volatile hour or so across all markets. But there was one outlier to me, Stephen, and that was the bond market. It really didn't move very much after the announcement. Yes, it had calmed down. The Treasury market had calmed down late last evening when Donald Trump did send this tweet out on the tariff delay, but it wasn't much of a follow through on the reaction. And as I'm speaking right now, 30-year yields on the day are unchanged on the day. 4.73 is where we trade. So maybe the bond market is taking some different hints from what we heard yesterday. Perhaps still worried about the climbing deficit if we do head into a small economic slowdown in the U.S.
Val, I want to prise your eyes away from the bond market for a brief moment to reflect on the superlatives in the equity market. We knew that futures were pointing higher. You're seeing gains now of 7.2% across the European benchmark Stoxx 600. Here in the UK, the FTSE 100 back comfortably above the 8,000 level, adding 465 points, up 6%. You're seeing gains of almost 8% over in Germany on the DAX. The FTSE MIB in Italy gaining more than 8%. Every single sector in positive territory. Basic resources gaining almost 10% as a sector. Technology also performing very well. Just talk us through whether or not this momentum can be sustained, what it tells us about pricing in the equity markets, as there are still, of course, significant questions that remain around Trump's agenda.
Yeah, that's right. I have my eye on the Euro Stoxx 600 bank index rising 10%, the most since November 2020. I think this is a lot about the anxiety of an economic slowdown in Europe also being, I wouldn't say put to bed, but just reduced, right? We're not as worried as we were before, and you see that play out in all parts of the equity market as well. Even when it comes to the Bund market, it's trading as a risk-on in a risk-on way. We're seeing yields higher, which is just showing that money's coming out of more safer assets and going into the equity market. But on all sides, we're really seeing a risk-on sentiment drive really hard today, and it's just another day of sentiment swings from positive to negative, and it's been, I would say, a historic week for many asset classes so far.
Well, just to sort of unpick a little what's happening on European bond markets today, because you've talked us through the Treasury moves yesterday, but a significant move higher in yields today, repricing of where traders' expectations of central banks are going as well. Yeah,
well, to me, this is saying that the European bond market, the German bond market, is still trading as a safe haven play, right? It rallies when we're worried about economic growth, and it sells off when we're more positive about economic growth. The U.S. Treasury market has really lost that kind of correlation. Really since the COVID fallout, but it's made even more obvious in the last few months that we're not seeing a big Treasury market rally on growth worries. And on the converse, we're not seeing a Treasury market sell-off when we're more positive about U.S. growth. And that, to me, is saying that the U.S. bond market is trading more off of deficit worries, off of supply and demand dynamics, instead of a safe haven play. There is still a lot of chatter going out there that, yes, he's reduced some tariffs, he's pushed them back 90 days, but they're still heavy on China. And with China being a main player in the U.S. Treasury market, a big foreign buyer of Treasuries, there's still that concern out there that one of the big buyers of Treasuries will continue to step away from the market, and that could lead yields to just lead structurally higher in the next few years.